Hi, everybody. Brenna Baucom, Collective Wealth Planning. I am a certified financial planner and a certified tax specialist. And today I'm going to marry those two credentials and talk to you about what happens to your tax liability with proper financial planning. I am often talking to my clients about aligning their resources with what they care about. And most of them agree that paying taxes is part of our civic duty, but they aren't eager to pay more than they need to. Effective tax planning can help ensure more of your money is put to good use for you, for your community, or to be passed along to your heirs. In this video, I'm going to talk about strategies to reduce taxable income while you're working and while you're in retirement, and some ideas to consider incorporating into your estate plan. Let's start by talking about reducing taxable income while you're working. Effective income tax planning involves minimizing your taxable income through legitimate, of course, means. Here are a few examples of the ways I'm working with my client families to reduce their taxable income. The first is to contribute to tax-advantaged retirement accounts. These maximizing those contributions to your 401k, to your IRA, to your 403b, to your 457, whatever the acronym or the number combination. Contributions like these are often tax deductible, which reduce your annual taxable income. And in the case of a traditional 401k or an IRA, your contributions are going to grow tax deferred until they're withdrawn in retirement. The second might be a health savings account. So if you have a high deductible plan, you can contribute to an HSA. And your contributions are tax deductible, and withdrawals for qualified medical expenses are tax-free. So this not only reduces your taxable income, but it also helps you save for healthcare expenses, which is one of the biggies when you get into retirement. FSA or HRA contributions. So if you don't have access to an HSA, you may have access to something called a flexible spending account or a health reimbursement arrangement offered by your employer. These two are pre-tax accounts that can be used for eligible medical expenses, which will reduce your taxable income. Bunching charitable deductions. So this involves grouping multiple years' worth of charitable contributions into a single tax year. And by doing that, you may itemize your deductions in that year and benefit from a higher total deduction. In the alternate years, you take the standard deduction. And this strategy is particularly useful when you expect your itemized deductions to be pretty darn close to that standard deduction threshold. And in 2023, when I'm recording this, the single filer deduction is just under $14,000, and for married filing jointly, it's just under $28,000. So those are some higher standard deductions that came from the Tax Cuts and Jobs Act. And many individuals are finding this bunching charitable contribution an advantageous approach in this time. The fifth idea might be to not only contribute to your employer-sponsored retirement plans, but also taking full advantage of their match, right? A lot of employers will offer matching contributions to your retirement accounts, effectively giving you free money, while those contributions that you make will reduce your taxable income. Investing in tax-efficient funds, so tax-efficient mutual funds or exchange-traded funds, or also known as ETFs, they typically generate fewer capital gain distributions, which minimizes your tax liability. And finally, rental property deductions. If you own a rental property, take advantage of the deductions for expenses related to it. These can help to reduce taxable income as well. So we have talked about ways to reduce tax liability while you're working, but what about when we are planning for and entering into retirement? So as I discussed earlier, retirement plans, really that planning involves using tax-advantaged accounts like IRAs and 401ks, and these can help you save for retirement and provide those tax benefits while working, reducing your income. But they can also create a headache in retirement when you're trying to mitigate your tax liability, particularly if you have other forms of fixed income like Social Security or a pension. So proper planning can help you optimize your finances during retirement, ensuring that you are keeping more of your hard-earned money. So here are some of the strategies that we look at for retirees. The first might be Roth conversions. And this involves converting a portion of traditional retirement accounts like an IRA or a 401k into a Roth. And when you do that, you're going to pay taxes on the conversion. And the Roth account, though, the benefit of it is that it offers tax-free withdrawals in retirement, which can reduce your taxable income during your retirement years. So this is often a strategy I see is a good fit for people who retire and then have some time between when Social Security kicks in, or maybe their pension starts. Their income is lower than it was when they were working, and they have a little bit of leeway in a few years to make some of those conversions, making them less expensive. So that's one. Strategic withdrawals is another. So being really thoughtful about the timing and the amounts of your withdrawals can minimize the tax impact. So for example, you might want to withdraw from taxable accounts first to allow the tax advantaged accounts to continue to grow, tax deferred or tax free, depending on what they are. And typically it ends up being a balancing act of identifying, okay, we have these pieces of fixed income, what makes sense to fill in the rest and stay in a smart tax position. The third might be Social Security timing. So you might know this. If you delay claiming Social Security benefits until your full retirement age or later, you can receive higher monthly payments than you would otherwise. Your benefit will grow 8% every year between your full retirement age and age 70, which can reduce the need to draw down on other taxable retirement income sources. Tax efficient investments. So holding tax efficient investments, just like we talked about for those who are working in those taxable accounts, that can help to generate fewer capital gains and minimize taxes on those investments. Qualified charitable distributions. This is a great opportunity for those of you with a charitable heart. If you are over 70 and a half and you have a IRA account, you can gift from that IRA account to your 501c3 of choice, and no one pays the taxes. If you are subject to required minimum distributions, that can go toward fulfilling that required minimum distribution. And even if you aren't required to take distributions from your IRA yet, if you are over 70 and a half, you still have this option available to you. The Secure Act being passed at the end of last year has changed the RMD date for some people. So the QCDs, the qualified charitable distributions, is such a lovely opportunity for people to kind of make the best of both worlds. And I've got a video on that I will link somewhere, wherever YouTube puts it, up here somewhere, and you can check that out. The other resource, if you are looking to mitigate your tax planning in retirement, is tax efficient withdrawal orders. So plan on the order in which you're going to withdraw from your accounts. So I just mentioned we might start with taxable accounts, we might then move to tax deferred, and then maybe to tax free accounts. It depends on your unique situation and what your other income sources are. And finally, qualified dividends and capital gains. So in your taxable accounts, holding investments that produce qualified dividends and long-term capital gains, these typically receive favorable tax rates. So skillful tax planning can not only reduce your tax liability, but can also help you avoid some of these surprise taxes like net investment income tax or Medicare IRMA surcharges. I have clients who get so frustrated about those darn IRMA surcharges, and they are a cliff. If you are $1 over a certain amount in taxable income, they kick in. So all the more reason to be thoughtful and mindful, proactive throughout the year to try to avoid those if possible. So efficient tax planning within your financial life doesn't stop during your lifetime, right? It goes on and on. So there are two types of estate tax that proactive planning can help you plan for. One is federal and one is state estate taxes, which is important to those of you here in Oregon tuning in. I'll start with the federal. The federal estate tax is imposed by the US government on transferring assets to our heirs when we die. And it applies to estates with a total that exceeds a certain threshold known as the estate tax exemption. And the federal estate tax exemption is about $13 million per individual, 12.92 to be exact. And estates that are over that amount are going to be subject to federal estate tax, which can reduce the overall amount that's passed along to heirs. Here in Oregon, that amount is much lower. So similar in many ways, this is going to impact the amount that is being transferred on to your heirs. It applies to a certain threshold, but that threshold is much lower. It's $1 million per person. So estates over that value are going to be subject to the Oregon estate tax, which ranges from 10 to 16%, and again, can reduce the assets passed along to heirs. So Whether you are planning around the federal or the state estate tax, here are some helpful takeaways to think about and talk about both with your financial advisor and your estate planning attorney. The first is the tax exclusion. So this is one of the most straightforward ways to reduce your estate taxes, and it's by making gifts during your lifetime. So you can gift up to $17,000 per person per year without needing to file any additional information on your tax return. So for example, if you are married and you want to gift to your adult daughter and her family, you and your spouse both can each gift $17,000 to your daughter and $17,000 each to their spouse. And that would make a total gift about $68,000. So that's pretty significant, right? So this amount is known as the annual gift exclusion, and it increases every year with inflation. So gifting this allows you to transfer assets to your heirs during your life, which I believe has two benefits. The first is giving while living, and seeing the impact of your gifts can be incredibly powerful. The second is more technical, right? Reducing the overall value of your taxable estate means that less is going to be taxed upon your passing. The second strategy to consider is the use of trusts. So there are various types of trusts. An ILIT, an irrevocable life insurance trust, is one. A grantor retained annuity trust, or a GRAT, is another. These can effectively reduce estate taxes. And essentially what happens is you have the trust and you put your assets inside of that trust, and they are removed from your taxable estate while still giving you some level of control to provide for your beneficiaries. So trusts can be structured to align with your specific goals and needs, and there are lots of great estate planning attorneys to help to facilitate the execution of that. The third planning opportunity might be the marital deduction. So if you are married, consider taking advantage of this. This provision allows you to leave unlimited assets to your spouse without incurring any estate tax, provided that your spouse is a U.S. citizen. And this can be really effective. It can double the estate tax exemption for married couples, and any unused portion of this exemption from the first spouse can be added to the surviving spouse's exemption. So a little bit of estate planning weeds we got into there, and walking through them though, and kind of understanding what your options are before you meet with your estate planning attorney can really help empower you to understand what your options are and open up the conversation. So thank you for your time and attention. If it's not clear by now, strategic financial planning at its best really should be designed to minimize your tax liability, giving you more savings, greater wealth preservation, and ultimately peace of mind. So by staying informed about tax laws, making tax-efficient investment choices, adjusting your financial plan, all of that can have a positive influence on your bottom line in a really meaningful way. I'm going to link to a video blog below for you to check out with a little more detail about this, including a few checklists for you to look at. I, as always, invite any questions you may have as you work to understand and mitigate your tax liability. Thanks for watching.